Good afternoon, everybody, and happy Thursday. Welcome to session 2, lesson 2 for our New to Investing webcast series. I'm Alex Coffey. I'm a senior trading and derivative strategist here at Charles Schwab, as well as the host of Next Gen Investing on the Schwab Network. For those unfamiliar with the Schwab Network, it's a separate but affiliated subsidiary of the Charles Schwab Corporation that is produced by the Charles Schwab Media Productions team. That's a shameless plug, but check it out every day, noon to 1 Central on YouTube and schwabnetwork.com. But today's goal is we're going to help to get new investors across this 8-part series from beginning to a level of confidence around the context and the things that go into making investment decisions. Before we get into what we'll cover today, though, a couple required housekeeping items to touch on. Today's discussion is for general informational and educational purposes only. Nothing discussed today should be considered individualized investment advice. Investing involves risk. That could be, of course, losing the principal invested. And any examples that we look at on the platform, we will have a demo experience up briefly towards the end of our webcast here today. Just know that those demo features, they're not real funds, and sometimes the functionality, the data, and just the general experience can differ in ways from a traditional, live Schwab account experience. I should note as well that it's a moderated chat today, so for those joining us live, if you have questions, my colleague Connie Hill is in the chat there to help assist you in real time as well. Now, before we get into what we'll discuss today, as I already said, today is the second part, so it's entitled How the Stock Market Works. We'll do a brief overview of what to expect throughout this 8-part series. So in session 1, it was really around the topic of compounding and the power of time when it comes to investments. And one of the things my colleague Rachel talked about was thinking about saving, sort of like storing, and that's money that you're sort of setting aside for protective reasons. Perhaps it's an emergency fund to cover bills in the event of hardship, whatever it may be. But when you get to a certain level, and that's different for everybody, where the savings needs are met, those additional savings, dollars that you would have from employment or other, sources, could be then put into investment vehicles, such as the stock market, which we'll talk about today. But the reason investing differs from saving, even though they both involve setting excess capital or money aside, is that investing is in exchange for some risk. You are basically putting yourself in a situation where that capital could see some reward. In this case, it would be you invest that money and you would hope to see that investment turn into a greater size, so return on that money. And that's really the idea of compounding, which is as you invest over time and that grows, as it grows, that larger sum continues to grow as well. And so it's almost like a snowball rolling down a hill, gathering more and more snow as it goes. And you can see, even if you've ever done that, you've built a snowman, whatever it may be, it can quickly become a much bigger, boulder-sized ball from what was, initially just a single snowflake. Now, today we'll talk about how the stock market works. But as we progress, what you'll notice is there's a natural progression from talking about the concepts. We'll start navigating the demo experience on the platform to kind of show you what these things would look like in practice. And then ultimately, we'll build those skills, ideally, to where someone would be able to confidently build perhaps their first portfolio or investment, while also hoping, and some of the things that we'll cover towards the end, avoiding some of those key pitfalls that new and old investors wrestle with on a daily basis. So as we move on and discuss, we've already went over, we'll go through our agenda, we already went over what the series expectations are, and really what the plan is over these next several weeks. But today we're going to introduce how the stock market works and what it is and what a stock is. And we'll spend a lot of time discussing sort of some kind of key distinctions and definitions. And then ultimately at the end, we'll pull up the platform if we got some time, and we'll look at what this looks like in practice over time as these different stock prices, which we'll talk about, oscillate and move around. And so we'll start with a very, very basic question. And that question is, what is a stock? Is it, just the numbers that you see on a business screen? Is it the number quoted on the evening news? And in some ways, yes, but really, a stock share represents a partial ownership of a company. And so when you buy a share of stock or a partial share of stock, you're buying a small piece of that business of which those stock shares represent. And so what you get in exchange for that is you have a claim towards those future earnings and growth potentials of that particular company. And so the idea would be you would buy shares in something that you believe in, that you think has the opportunity to become a bigger and bigger business that makes more and more money in time, because as a small owner of that company, that's where we get to how can we make money? Well, if the value of that company goes up and I own a small percentage or fraction of that company, well, my piece of the pie would grow as well, and that's stock appreciation. So the idea on that is to buy, when the prices are lower than ultimately where you think they're going to be. And so we say buy low, sell high, and that's the kind of classic phrase, but really it's buy in hopes of it going higher is the name of the game when it comes to investing. Another way that you can make money through investments like a stock share, for example, is some companies elect to take those earnings and reinvest them into the company, and that, of course, helps them grow. But others have stable businesses, maybe feel that their position in those businesses is secure, and they take that excess earnings, that excess income that they make as a business, and they return it back to those who are shareholders, or in this case, the owners essentially of that business. And that could be anyone who has the shares. And so if they elect to do this, it's called a dividend payment. Not promised, and certainly just because they declare them doesn't mean that they're going to do them into perpetuity. So there are risks associated with that, but it's essentially them sharing those earnings back with the owners in the form of, in many cases, a cash payment on that investment. And so it can be both a growth vehicle through appreciation and also an income generating investment as well that is paying you if those dividends became more regular and it was something that was consistent on a regular payment schedule. Some it's monthly, sometimes annually, quarterly, but that would be essentially a income stream for that investor. So that's another way to do that. But what we should note is, although over time, we talked about this with compounding and the idea of stocks generally, especially ones that have performed nicely and have had strong businesses, have gone up over time. It's important to note that doesn't happen in a straight line. So you may hear things like, the market appreciates on average 9% or 10% a year, but that doesn't happen, in an equal fashion over time. There's peaks, there's troughs, there's movement as those stock shares trade on what is called the stock market. And so the stock market is essentially a place where buyers and sellers trade that ownership. And so as we move on and we start thinking about some of the risks associated with stock investing, I thought it was a nice kind of timely quote from Charles Schwab himself that I think fits this discussion. So I'll read it here for you. He says, "Why be an owner in a company? Essentially, it gives you a piece of the action of what that company is doing. And for a very small amount of money, you can buy 100 shares of a company and have all the benefits of that company growing 1, 2, 10, 20 years, your investment works for you morning, noon, and night while you go about your profession. And this is a great efficiency you have about investing. And this was the idea that Rachel in the first session really discussed around compounding, which is investing, if done successfully, allows you to have your money working for you while you're dealing with the other things that are basically taking your time, whether that's your profession, whether that's raising a family at home, whether that's going back to school or being in school, depending on your age, and things that take us away from things maybe like focusing on money. You can make the investment decision and then give it time, and then over time, if it's successful in working, it's doing that work alongside the things that you are doing. And so, of course, in order for there to logically have an opportunity for there to be a reward, there has to be risks. And we're going to go through 4 of the key risks, kind of high-level risks associated with stock investing. The first one is a relatively clear one, but it's a tough one to wrestle your mind around. And it's this idea of just general market risk. And factors like interest rates or inflation or economic slowdowns can just dampen sentiment and change the dynamics for just the investing landscape as a whole. And in market sell-offs or market risk situations, even strong companies with really, really strong products and growth and a lot of things going well for them can still decline because the overall market itself is weak. That type of risk is difficult to completely eliminate, and it can't simply be eliminated by having several different stocks. And so it's important to acknowledge that when you're making an investment decision, you are accepting some of these risks, particularly market risk. Now, another one that I think is a little bit easier to grasp is company-specific risk. You decide to invest in a popular footwear maker, let's say, and a competitor makes a product that is a little bit more popular, and that the company that you originally chose to isn't selling as many footwear products that it thought it would. Well, that can be disappointing, and it can also have an adverse effect on the stock itself. So this can be a wide variety of things, but generally think of that as, hey, a company-specific misexecution or a failure to live up to the expectations that basically the market had for that particular business. So a way to think about this, high level, market risk generally impacts everything, while company risk impacts just those specific companies that are, of course, tied to those risks themselves. Now, there are also risks tied to how a company actually structures its financials. And so for those who were accountants in school or took those accounting classes, not the most, fun stuff to look at, but a big part of the discussion when you're making an investment is how sound is the financial picture of this business? Do they have a lot of debt? Do they have a situation where, their structure doesn't have enough cash flow to actually maintain the debt levels that they have? A lot of times you'll see this in companies that maybe their business at one point was very strong. It's found itself in maybe a bit of a hardship time. It's taken on debt to keep things going, but it never quite turns around. And sometimes it can be just economics are changing. And a recent example of this that kind of jumped out to me when I was looking through these slides before this webcast was Spirit Airlines. Spirit Airlines, the economics just stopped really working for that business, and it was forced to kind of go the way of financial risk. And so it can be still a well-known brand. There's plenty throughout time that you think about that had sort of taken on too much debt and were unable to service that particular level of debt. Now, the final one that we'll discuss is a little bit more, I think, timely, and that's this idea of sort of sector and industry risk. And at the same time, this risk also, I always say risk and reward are two sides of the same coin. On the other side, there's opportunity as well. And so one of the sectors that really stands out to me Of course, there's natural ones like energy or tech or healthcare that sort of perform differently throughout economic cycles. But in real time, we're watching software, which is sort of an industry or a subsector of technology, really find that it's struggling in the last 6 months to a year as AI is really rapidly changing the landscape for what those companies' business models might look like over the next 2, 3, 4, 5 years. And as a result of that, investors have a little bit less confidence. Because they have a little bit less confidence, they were selling shares, and you see many of those names significantly lower over that time period just because there's a lot more uncertainty around their long-term trajectories. But we got a few more minutes left, so I wanted to pull up here the Schwab.com demo experience so that we could just get an idea of sort of what stock trading and investing and some of these different well-known names that we'll discuss in a moment actually looks like graphically. So we'll look at a couple charts. So I pull up here our platform. What you'll see is where I'm actually on, for those who would maybe be following along, is just the research screen underneath US markets. But what this will populate is basically a screen with the general performance of the US stock market indices on the day. But what we're actually going to do is go into the enter symbol or name section here. We're just going to key in Apple. Now, Apple today, for those who are paying attention, you can spell it out just as Apple, as I did, or you could key in the stock ticker if you know it, which is AAPL. Either way, we can select it there from our list. Apple today announced that it was going to raise prices on some of its consumer products, and as a result, it saw its stock shares under pretty significant pressure. It was down over 6% today, which is a meaningful move. And you can see here on this chart, which I'll click Show More and expand it so it takes up a little bit more room here for us. We'll actually zoom in and we'll take a look at just this year so far. And so this is just since the beginning of the year. And what you can see is despite the fact that Apple has actually moved higher slightly, it has moved up and down and all around in the last several months, and today being no exception, with it moving down quite significantly. And the reason I chose Apple is just generally, not that it's a good buy or not a good buy, but just generally it's a product and company that I think most of us are pretty aware of. And so you can see so far year to date, it has been up and down. It's up more than it's down, but not significantly. And certainly it was up significantly higher just a few weeks ago. But as you extend this out into time, what we can do is we can go ahead and go to 10 years. You can see a lot of the same picture exists, but over time, it's generally moved higher. So we would call this an uptrending stock. And so it's had its ups and downs, moved around, and there's been periods, you can go back to 2020, which looks just like a blip now, but there was serious market risks in 2020 and in 2022. And even last year, in the middle parts of 2025, that brought down even strong companies like a name like Apple, where today was a little bit more company-specific risk. Now, to kind of balance this out, another brand and company I think that we're all pretty familiar with is Nike. And what you'll see on Nike over the last 10 years is a much different picture. The first 5 of those years was a really, really nice, strong performing stock, one that saw its stock shares go from around $50 per share all the way up to well into the 150, 160, 170 range to the upside. That would have been a significant stock appreciation in a portfolio. But as you can see over time in 2022 and then ultimately and beyond, what you've seen is a more bear market situation and a stock that has become in a pretty severe downtrend, making a full U-turn and then some. This is actually a stock position that has a lower stock price than it did 10 years ago, despite the fact that Nike is as well known as any brand, I would argue, on the planet. And so maybe it's been some company-specific execution concerns for this one, things like tariffs as well. But That's a nice place for us to leave our discussion for this week. Next week, we'll dive a little bit further into Schwab.com's web platform. We'll discuss some of those essential parts of that platform. Thanks as always for tuning in, and we'll see you next week.